Thank you very much, David. In fact, given that Jim gave Reinhardt and Rogoff a plug early on, maybe I should give my plug to David right now. The question we might try to address this afternoon is, the mess we got ourselves into, was it because bankers were, shall we say, willfully incompetent, or were they genuinely the banksters of David's book? It may be some comfort for us to know that, again, the subtitle of the book to which Jim referred earlier, this book by Reinhardt and Rogoff, This Time is Different, in fact was 800 years of financial folly. So if it's any comfort to us, and it probably is not at this stage, but I mean, we may as well cling to whatever comfort we can. We've got a long and a dishonourable roll call, and we're just the latest victim, albeit in a rather larger scale. And indeed, Emily spoke earlier about the social cohesion of the Nordic countries and so on, but yet they were not immune. 1990, they had a very serious brush with most of their banking system failed in the Scandinavian countries. And again, in fact, one of the reasons why we actually have a Finnish regulator, let's say practitioner coming in to conduct the ultimate banking inquiry, which is about to start now, to top off the two we've just finished with, is because of their experience in that area. And indeed, they have come through. So it is possible to actually come through and succeed. But so, as an academic, I thought maybe I might ask the question, well, is there something in banking that makes it particularly prone to shooting itself in both feet? Is there something about the nature of the risks that they're taking? And indeed, in other words, is there any reason to think that somehow this was not simply badness on anybody's part? Because clearly there is a tendency right now to go off and say we'll give them a fair trial and then we'll hang them. But maybe we might just simply have an open mind and let's see what was it that banks did, and how did they depart from what we might consider to be best practice. So again, maybe I'll start off with what we might call in academic circles banking 101. In other words, what are banks supposed to do? What is their function in society? And to what extent did banks depart from that? And was it that tripped them up? And again, then following the theme that's already been alluded to earlier, human weakness really comes into it in the end. It's not that people are unaware of the basic principles. In fact, it would be wrong to even suggest that they aren't, but maybe it's no harm to review that and to see how human interaction can cause people, despite their best efforts, to stray from the path of probity, shall we say. And then finally to see why it is that regulation is required, and then why it is that certain types of regulation failed to keep people to that path. Again, Emily described how we can get out of the dirty habit of using 20 plastic bags every time we go to the shop, because it's regulated. Again, I believe that appropriate regulation can actually have a similar effect in banking, without killing the innovation that we all speak of, or we all look forward to having. In fact, it's interesting, Paul Volcker described that the only useful piece of financial innovation that he's aware of is the ATM machine. But in fact, most people would actually suggest that the financial innovation is simply another way of banks finding new ways to shoot themselves. And so what of the future then? Given where we're at, what does the future possibly hold? And again, is it possible for us to dig ourselves out of this hole and again get back onto the path of growth? So I suppose that comes to the basic point of banking, and banking hasn't changed really. And again, to Paul Volcker's point, it hasn't changed in hundreds of years. The function is still the same. We're still buying and selling money. So what's different about the risks that are being taken in banking? And I suppose the fundamental one is there is no upside. So effectively, if you make a good loan, you get your money back. Gee whiz, great. But unfortunately, as I say, in fact, it's even worse than that. If you give money to an individual or a company and their prospects improve, you get your money back early. You don't even get to enjoy it for the 3-year loan gets repaid after 6 months. They go down the street and they get it for 0.5% cheaper, the same loan from some other bank. So therefore, you don't even get to enjoy the benefits of success. So there's only downside. And again, as I say, the downside is default. And remember, for every, let's say, in a typical banking environment, it takes 50 successful loans, if you like, or 50 loans to people who paid back their mortgages to actually pay for the one who doesn't. So therefore, the margin for error is, as I say, is particularly small. So, as I say, banks are what we call, they've written what we call a portfolio of put options. They've given people the right to do two things, both of which are detrimental to the bank. One is they prepay, which I suppose in the current environment would be no bad thing. But the other alternative, which is much more frequently exercised right now, which is the right to default, which indeed, as I say, people are doing and continue to have done, especially in the last couple of years. So again, it's the basic idea of small potential gain versus large potential loss. And if that's the environment in which you're working, as I say, you just have to be, there is no room for error. It's sometimes characterised as picking up nickels from in front of a steamroller. So you've got to do that very carefully. In fact, some others rather less, shall we say, not quite the same language would say it's that banks that they are indeed option writers generally, they feed like birds and crap like elephants. But so again, if you look at a corporate balance sheet and you say, well, look, gosh, that's fine. Bank balance sheet, they don't look too different, do they, really? So why are banks different? Why do banks end up falling over themselves all the time, or at least with excessive frequency in any case? And possibly this is one of the reasons. If a bank were to go to another bank, like normal corporates do to banks, and say, please may I have some money, the first thing they'd be told is, hey guy, you better put a lot more equity in there. But banks themselves don't abide by their own rules, because obviously banks actually work on the basis that they actually earn, dare I say it, a modest spread on assets. People might say you're already paying too much on your loans, but it's a rather modest spread, and the only way the banks can actually get that to a decent return for their equity shareholders is by leveraging it. So they leverage it 15, 20 times typically. If there's once times leverage in a normal corporate, it would be considered to be quite a lot. More importantly, the assets the banks have, or the debt they give to other people, other firms. So what you might say in summary is the banks are highly leveraged corporates with a poor funding structure. In actual fact, they are destined to fail to some degree. And indeed, it's only really for the reason that, for the most part, they have what they call a government backstop, if you like, or a guarantee that there's a central bank standing behind them somewhere that says, guys, don't worry, you can leave your money on deposit with this bank and not worry about it, because we'll guarantee it. It's only on that basis. Otherwise, we'd all take collective fright 10 times a year, and the banking system would collapse before we knew it. So another thing is, the nature of risks that banks take is completely different from the risks that are taken in most other parts of most other sectors of society. As I say, first thing is customers' default rates spike. It's not unusual to see default rates 20, 50, 100 times higher in the height of the recession compared to in the depth of the recession, should we say, compared to the height of the boom. Who else experiences a kind of a ratio of their variable costs like that? None to my experience. And again, what's more, banks themselves, as we've already seen, are highly leveraged. So therefore, in some respects, banks have to continue to go out and look to borrow themselves. So any bit of bad news out there immediately will bring into question whether or not they themselves can access the funds to continue to allow them to do their business. So as I say, in general, a very small margin for error. So therefore, I suggest we should not be surprised periodically that error, in actual fact, does trip us up. So again, just as a kind of a characterization of that, you can imagine, let's say, the states of the economy. Let's say the normal state might be 1%, 2%, 3% growth rates. In the boom years, such as we had for the 15 years prior to 2007, well, certainly about 10 of those 15 years, you had 7%, 8% growth and ahead. And again, in that period, there would almost be no defaults. Whereas in recession, as we've had right now, you had far greater defaults. So therefore, what you find is the same customer could find itself, let's say, because it's dependent on the state of the economy. As I say, we've had that. In this case, I just put in a single graph there. A customer has 1% probability of default. So therefore, if you were completely unaffected by the state of the economy, you would default with that kind of probability. Or if you had a portfolio of 1,000 customers, 10 of them would default every year on that basis, which would make for a wonderful customer base. Sadly, it doesn't work like that. And most of the time, in fact, customers don't default at all, or they have very little default. So in that circumstance, we see a scenario where in the boom years, it's almost negligible default occurs. And then in the height of the boom, the depth of the recession, despite the fact that these customers have an average propensity to default of about 1%, you find that maybe 10% of the portfolio of customers actually defaults. So it's extremely variable. So therefore, what does that tell us? given the low margin for error, we should therefore try our best, obviously, to adhere to good lending practices. And the basic one is to base it on free cash flow. So, again, what that would say is, unless you actually have cash being thrown off by the venture and it's capable of servicing the loan, it's not a bankable proposition. So, therefore, if we think about what are the obvious failures in the banking sector, that are obvious asset projects that fail that test, land and development property, and we have collectively 49 billion of such assets heading to NAMA right now. Again, it would be Banking 101 would suggest those particular projects never displayed the characteristics that would allow you to actually feasibly offer them finance. And sadly, they did. And we'll come to why that might have happened in a little while. Again, reliable cash flow characteristics. So it's not just simply free cash flow, but you have to have a strong belief that that cash flow will persist. So in that case, we talk sometimes about a strong covenant, that there must be something strong behind all that. And again, typically you'd be looking for somebody to be in employment, and you want to make sure that the payment on their mortgage is not consuming as an excessive part of their after-tax income. Clearly, you will still be exposed to their losing their job and so on. And of course, I think everybody would want banks to go off and be willing to run that risk, because hopefully on a portfolio basis that will actually work its way through, that we hopefully won't all lose our jobs together, although sadly too many of us are at the moment. And again, another one that would be typical for in terms of property, that you don't look to the property developer as the source of your income, because the property developer as such has no ongoing business. Every property developed is actually a new business. What you're really looking to see is there somebody that's going to move into that property having been developed? So is there a new anchor tenant moving into that shopping centre? And again, as I say, speculative development doesn't actually fit that bill either. And again, there's been an unhealthy reliance on collateral and guarantees. And sadly, no more than Sam Goldwyn, it's not worth the paper it's written on. I mean, his verbal assurance. In this case, the guarantees, sadly, are worth least when they're most required. So therefore, they should at best be regarded as simply a way of mitigating the loss when default has already occurred. So, knowing that to be the case, and knowing the differential between the potential for borrower probability of default to increase significantly in a downturn, what we're saying really is you need to diversify your portfolio, and therefore, so some of us maybe who let's say do any sort of finance course will probably come to be aware that you can create that kind of diversification within the stock portfolio with only 15 or 20 stocks. Sadly, stocks gain on the upside. In other words, it's like private equity. You can afford to have 9 projects fail because the other one is going to pay you back 10, 20, 30 times. That's your hope. Whereas in the case of, as we've seen already, bank loan portfolios don't actually have any upside. So therefore, it takes thousands to actually diversify. And therefore, what that strongly suggests is that you do not put all your eggs in one basket. I mean, you didn't, Granny told us that years ago, but I mean, I think the discipline is even stronger than even she recognised. So we can't have large exposures, but sadly, as I say, because if you do, of course, the bank's own ability, we saw how little a capital cushion there was in the banking system. Therefore, its ability to withstand loss is actually quite limited. And indeed, even apart from becoming decapitalised, it simply the market can take fright even by losing 2% of your capital base. So therefore, it's not enough to talk about whether it's 8% or 6%. If you lose 2% from wherever you start, it's almost certainly going to give the markets cause to take fright, and suddenly you won't be able to access the international lending markets. Again, this idea of whether you're a going concern or a gone concern, in other words, going concern, to be able to absorb that and continue going, you really can, 2% is about as much loss as you can ever possibly absorb at any one time. So therefore, a basic rule would be that no borrower can represent more than 5% of the bank's capital. But yet again, we've seen here the largest 100 borrowers in NAMA represent over 140 billion rather. Again, clearly those rules, Banking 101 again, so they suggest, have actually been ignored. Again, were people unaware? I don't believe so. We'll come to that again in a second. So again, back to the idea that if you start then putting your eggs in one basket, as I say, what happens? Well, if it's a well-diversified portfolio, you could find that kind of variability. The green line there represents the variability that you might see in default rates within a bank loan portfolio from one period to the next. So if, again, we had an average of 1%, and both of those distributions have an average of 1%, what you'll find is that the actual distribution itself is fairly tightly within 50.5% up to, let's say, roughly 2%. However, start introducing an element of correlation. So in other words, start introducing either, let's say, significant exposure to a number of individuals, or indeed have a huge exposure to a single sector. What you then find, of course, is a much more skewed distribution. But again, this point is one that I think I'll refer to again and again for the rest of the talk. It's largely because of the fact that most of the time what you see is virtually no defaults at all. And that's what we saw in the 15 years prior to 2007. Really, there weren't any defaults. And the longer that continued, the more we became brazen, the more we thought that this time is different. There is a new paradigm, maybe. There never is, of course, but the fact is we get to think that. And the longer the doubting Thomases are shown to be wrong, and all the Jeremiahs that actually the forecast we'd fall off a cliff in 2002 and again in 3 in 2004, by the time 2005 and 6 came around, they'd probably finally said, look, I better give up on this because it ain't working out. I mean, the fact is that you can be wrong, you have to be wrong for a very long time, in the sense that the probability of default always in that portfolio is 1%. It's just you never saw it happening. So what you therefore find is you must obviously be constantly aware of the potential for downside. So go back to what must a bank be? Well, it must itself be creditworthy, because after all, a bank can only lend to you at a spread over what it can borrow at. So therefore, if a bank itself is in a bad state, and obviously a lot of our banks are in a bad state right now, and they can only borrow on the strength of a government guarantee, they are themselves going to have to pass that on, and we're seeing some more of that in the newspapers, a discussion of it today. Again, trust has been mentioned more than once already. Again, we must have trust, and obviously the biggest single task for the banking system right now is to regain the trust, to show that it is behaved differently, that it has indeed learned from these lessons, and will somehow behave itself in future. Again, the main reason for it is because every single day you're exposed to having to refund yourself. Liabilities, the borrowings that you have, must be constantly renewed. You must constantly keep your depositor happy, not to make sure they don't withdraw their deposits. And again, you must borrow in the international markets to make up other short-term sources of funding. So again, self-restraint is actually the key criterion almost. And what that really means is that you must obviously resist the temptation to stray from sound principles, which again requires, as Jim described earlier, the need for strong corporate governance. But that actually requires you must be willing to be wrong for a long time. In other words, in the banking sector, and again we spoke a lot earlier about, again Margaret spoke about this kind of business, we all have this herd instinct. In order to avoid the herd instinct, you have to be able to go off and observe somebody else doing something which is apparently successful and doing it over many years and still resist the temptation. And nothing thwarts people's judgment than watching the guy next door get rich. So you are much more likely to go off and do something stupid. You're much more likely to be drawn into buying that other property, which is only 15 or 20 miles from downtown Ennis, in 2006. So the fact is that you have to be willing to bite your lip, to show that kind of self-restraint all the way through. And as I say, it is more than a difficult task, because you do get the snide remarks. You do find you're losing your best people to the rogue competitor. And therefore it is especially difficult discipline. So it's not that people don't know, it's just that actually, because again I think the phrase that Jim used earlier was that, again, not to do any disservice, I better try and say it correctly, but I thought it says competition is real, disaster is an abstraction. And again, it isn't any, I couldn't say it more eloquently than that. It is absolutely the case that we all know that it's there, but yet if you keep seeing somebody getting away with it, and actually the more concentrated the portfolio, in other words, the more you break the rules, and the more likely you are to get away with it for longer, because you're putting all your eggs in that one basket. So the way you hope, so then of course, when that wave does come in, of course, there's not a single egg left that's unbroken. But the fact is that if you had lots of different baskets, there's always a wave catching some basket, or rather breaking some eggs. So therefore, it's actually a very difficult discipline to implement, and that's part of the reason why sensible people, they're not malicious people. And again, I would reiterate kind of Jim's comments there, that it's not that the actual standards in banking are somehow any less, the people are any more malicious. I think it's simply the fact that it's such a difficult thing to read. We're talking about the most basic of human understanding, that in other words, watching a strategy be successful, you continue to think, well look, it's like gravity, it'll always be so. Sadly, it's not like gravity. And of course, the more it's not a sound strategy for us all to continue to borrow more money and to buy houses from another. It will stay that way until suddenly somebody says, oh gosh, I think that's a little bit too high. I'm not going to pay that price any longer. And then suddenly the air is left out of the balloon. Again, it'd be interesting what Margaret's view on this would be. I would say accounting is no guide, and indeed the accountants themselves, I think, have actually seriously misrepresented the situation, because what you find is, and this is not, sorry, that's not a criticism of you, Margaret, the international financial reporting standards demand that people only make provisions for loss when those provisions become evident. So in other words, if somebody's continuing to pay their loans, and there's no reason to doubt them. But sadly, history will tell us that over periods of time, that you will actually end up with this much longer-term loss rate. Sadly, the accountants decided, and again, in particular, Sir David Tweedy, head of the International Financial Reporting or International Accounting Standards Board, insisted that no such provision be made, because it was more or less seen as cookie jar accounting, to be hiding away your money for the rainy day, which, by the way, I think most of us would be very happy banks had actually done. But anyway, that wasn't seen to be correct. So therefore, what you find is that banks tell you that you're bust, as I say, after you've gone bust, which is really not particularly enlightening. And so, against that background, maybe what we might ask is, well, back to the kind of idea that Emily mentioned earlier about regulation, what do we need for the regulator to do? Well, the first thing is, if somebody's playing fast and loose, well, first of all, you rein them in. Because again, what you find is after a very short while that their behaviour, again, lowers the standards that are being held generally within the industry. Because after all, it's one thing to actually have somebody misbehave and somehow do it, but if they're actually eating your lunch in the process, it actually is particularly difficult to have a stiff upper lip in that circumstance. So again, monitor and control lending standards, income multiples. We saw them going from, let's say, more normal 4 times income multiples to 13, 14 times. Again, it never made sense. But yet, somehow, if it became market standard, if somebody else was doing it, you ended up in that position. And again, loan to value, we went from the 70%, 75, 80%. In fact, in my early days, you asked, well, you go in, there's a store used to go, you go into your bank manager and ask, well, I'm looking for a bank loan, where do I stand? And the answer is, well, actually, you kneel. Well, we may well be coming back to that stage again. Again, limiting loan growth. The fact of the matter is the regulation, the most obvious and simplest rule of the world is anybody who's going, and again it's the one that Patrick Honan referred to in a recent paper of his, and it's standard throughout the world. Anybody whose loan books are growing by more than 20% per annum, they're simply not exercising any discretion. The answer is all comers, sign here please. And by the way, it's pretty easy. When you're giving away money, you'll always find somebody to take that from you. So again, you must limit loan growth. And as I say, you find here that, and again, it was a question, I think Margaret mentioned it earlier, the fact is, collectively, as a country, we have 65% of GDP borrowed firms and individuals. In 2008, it's 205%. Yeah, it could even be, But anyway, the fact is, over 3 times, the international norm is about 100% of GDP. Sadly, we'll all have to pull back in that environment. We can't continue to do that. We all get worried when the government debt to GDP ratio starts approaching 70, 80, 90%, and 100% is generally considered to be a threshold beyond which you do not wish to cross. Well, we've crossed it collectively as individuals and as an industry, so therefore we have to watch ourselves. And again, the other thing to note, of course, and unfortunately banks themselves fall victim to it, in that all their rules are setting it loan to value. Value is created by the loan you can get against it. So therefore, the more we lend, the more we drive up the prices. So therefore, you actually inflate that balloon even by the very fact of actually the property available. And of course, unfortunately, on the way down, it's also true. So to the extent credit is not available, it actually drives property prices down the other way. So against that background, what do we think? Well, obviously, in the very first instance, the banking system is currently entirely dependent on the government guarantee. So to that extent, the Irish government has actually difficulties. The fact that Greece is obviously having its difficulties, and Ireland is seen as in the next wave, hopefully not the next wave, but maybe the second next wave. Well, that ultimately reflects on the rate at which we can borrow. So we must ultimately reduce leverage in general, and therefore there will be minimal new lending, I would suggest. Most of the lending that's going to take place will be for refinancing existing loans, or again just minor amounts on the edges. So therefore, sadly, it's not, we can't afford to, we can't allow ourselves. We'll be largely in pay down mode. But again, I suppose the other thing is we actually have currently a much higher savings rate. So therefore, the savings of others will obviously go to fund those early in life who are, and those young, hopefully vibrant businesses that actually need those funds. So, as an overall final comment, really, just banking is a tricky business. It's in many respects it's very simple, but that doesn't make that. But the actual competitive dynamic is problematic. It is always that way, and we do need regulation, and we need it strongly. In many respects, the person with the easiest job in the world right now is in fact the regulator, because it's always easy to regulate after the downturn. The danger is of over-regulation, as has been mentioned already. We have to make sure we don't swing from excessive exuberance to excessive, let's say, risk avoidance. So therefore, the task for Irish banks and indeed for banks generally is to avoid chasing those illusory profits that the other guy seems to be getting by behaving badly. The old rules haven't changed, and as I say, it's prudence and just generally, as I say, to avoid the behaviour that says that somehow to get out of the habit of thinking that somehow we were worth it, because unfortunately deferred gratification still has benefits.